In this video, we will explore about earnings based valuation matrices. We will look at how to value a company using its earnings, dividends, and growth potential through various ratios like dividend yield, price to earnings, and enterprise value metrics. Let us start with the first concept, which is dividend yield and the price to dividend ratio. You must understand that dividends are simply the profits that a company pays out to its equity holders. However, companies rarely pay out everything. They often plow back a portion of their profits to fund future growth. When we want to know if a stock is cheap or expensive, we compare the dividends we receive against the share price we pay. The formula for dividend yield equals the dividend per share divided by the current price of the stock. To see how this works in practice, let us look at a numerical example. Consider a company that has a history of paying a dividend of 5 rupees. We can analyze this business at different market prices ranging from 50 rupees to 200 rupees. If you buy the stock at 50 rupees, your dividend yield is 10%, meaning the market pays 10 times for a rupee of dividend. However, if the price rises to 200 rupees, the yield drops to just 2.5%, meaning the market is paying 40 times the dividend. It is helpful to compare these equity yields against bonds to make a decision. Bonds might offer a coupon of 10%. After applying a 30% tax rate, the post-tax return is 7%. If the equity is trading at 50 rupees, it offers a 10% yield, which is very attractive compared to the bond, especially since equity has the advantage of potential earnings upside. Bonds, on the other hand, are limited because they are usually redeemed at face value with no upside. But at 200 rupees, the equity yield is only 2.5%, which makes it inferior to the bond yield. This comparison helps us understand the broader market context. In bear markets, equity is often available cheap, so dividend yields are typically higher than bond yields. In bull markets, equity becomes expensive and yields drop below bond yields. However, there is a critical warning you must heed. A stock with a higher dividend yield than its peers is not automatically a good value pick. A high payout often implies the company has limited avenues for expansion, which limits capital appreciation. Therefore, we must always check companion variables to see if the valuation is true or a sign of weakness. When dividend yields are low, analysts often move a step higher to look at earning yield to assess investment potential. Earning yield is calculated as earnings per share divided by the current price of the stock. The reciprocal of this is the famous price to earnings ratio or PE ratio. The PE ratio equals the current price of the stock divided by earnings per share. This ratio tells you exactly how much money an investor needs to invest to receive 1 unit of profit. You can visualize the PE ratio as a weighing scale. On one side, a high PE suggests the stock is expensive. Investors are usually only willing to pay this if they expect above average growth or a business turnaround. On the other side, a low PE suggests the stock is undervalued or cheap. Generally, companies with higher growth potential or lower risk trade at a premium, while those with lower growth or higher risk trade at a discount. Analysts must weigh these factors against peer group numbers. It is also important to look at the timeline of these earnings. We have historical EPS from the past and forecasted EPS for the future. Since investors value future potential over past performance, the period of reference is critical. We often look at the forward PE. If the ongoing year's EPS is unduly low or high due to temporary factors, analysts must use their judgment to determine the appropriate period, often shifting focus to the next financial year to get a cleaner picture. The problem with the simple PE ratio is that determining the specific premium for high growth is subjective. The solution is the growth adjusted price to earnings ratio known as the PEG ratio. This metric factors growth directly into the calculation. The PEG ratio equals the current price divided by EPS, which is then divided by the growth rate. Peter Lynch provided a famous rule of thumb for this. If the PEG is less than 1, the stock is undervalued. If it is greater than 1, it is overvalued. The philosophy is that a high PE is justified by high growth, but high growth does not last forever. Let us compare two companies, A Limited and B Limited, to see why this matters. Both have an earnings per share of 10 rupees. A Limited costs 120 rupees, giving it a PE of 12 times. B Limited costs 140 rupees, giving it a PE of 14 times. A Limited looks cheaper based on PE. However, A Limited is growing at 10%, while B Limited is growing at 15%. When we calculate the PEG ratio, A Limited is 1.2, making it overvalued. B Limited is 0.93, making it the better investment despite the higher price. Sometimes the PE ratio is not the right tool because it focuses only on equity and is impacted by debt. If you are valuing a company from an acquirer's perspective, you need a metric that is neutral to the capital structure. The solution is to use the enterprise value to EBIT or enterprise value to EBITDA ratios. These take into account the total capital, including debt and preferred stock, rather than just the residual interest available to equity. Choosing between these two depends on the industry type. For capital intensive industries, different companies might use different depreciation methods, which causes discrepancies in net profit. In these cases, use enterprise value to EBITDA to strip out the effect of depreciation. For other industries, enterprise value to EBIT is sufficient. The rule remains that a lower ratio is generally more attractive, subject to risk and growth. Finally, we have a scenario where none of the profit-based metrics work. You cannot use PE or EV to EBITDA if the underlying profit is negative, which represents a loss. This often happens during break-even phases where profits are artificially low. In these cases, we use the enterprise value to sales ratio. We use this simply because sales can never be negative. However, you must use this metric with a constraint. Enterprise value to sales is only suitable for companies that are likely to turn profitable and sustain it in the future. If a company is loss-making and a turnaround is not likely, the status of the business as a going concern is doubtful. In such cases, do not use enterprise value to sales. The company must be valued at its liquidation value.